Hey everyone, while the Indian stock market is facing a lot of volatility, there's one sector that is doing relatively well, and it is affordable housing finance. If you're following my channel, I've been very positive on the affordable housing finance sector and I've covered it earlier also. And if you look at some top companies in this space, Aavas is making a new high even in this weak market. This stock has corrected massively in the past, but I've shared my conviction when it fell down significantly. Then Home First is showing a good recovery from the lows. Another stock I like in this space is recently listed company India Shelter that is also showing a lot of strength. And fourth pick in this space is Aadhar Housing, also a recently listed stock in last year that is showing a good strength in this weak market. So in today's video, I have revisited the affordable housing finance sector of India where I have covered the key growth drivers, key risk and growth thesis and a comparative analysis of all these four listed affordable housing finance companies of India. The idea is to understand if it is a good time to consider these stocks at the moment or not. Alright, let's get started. So let's break down the growth drivers for affordable housing finance sector in short term and long term. If you look at short term, the biggest growth driver is rate cut by RBI. RBI has already started the rate cut cycle in India. The first rate cut happened in February month when repo rate was cut 25 basis points from 6.5 to 6.25%. This was the first rate cut after 2020 COVID period. And recently, RBI has again cut the repo rate by 25 basis points. So with the repo rate cut, banks and financial institutions can borrow funds from RBI at lower cost. Now you may wonder if housing finance companies are borrowing cheaper, shouldn't they pass on that benefit to end customers? Well, theoretically, yes, rate cuts should be passed on to end customer. But there's a catch. The catch is how much they pass on and how fast is where housing finance companies make their margin magic. Majority of affordable housing finance loans are at fixed rate or fixed for 3 to 5 years. So when housing finance companies raise new fund at lower cost, much of their existing loan book is still at higher fixed rate. As a result, during the rate cut cycle, housing finance companies' margins expand and they earn more on the same loan. They might cut rates a bit to stay competitive, but most of the benefit stays with them. And that's how their profitability improves in a rate cut cycle. Then second short-term positive factor is liquidity injection by RBI. In last few months, RBI has pumped significant liquidity in the banking and financial sector by purchasing bonds to boost the credit growth. It directly resulted in banks and NBFCs with more money to lend. Hence, housing finance companies can grow their loan book at faster rate. But of course, not every lender equally benefits. Those with strong books, controlled NPA and conservative growth stand to gain the most. As far as long-term growth drivers are concerned, first big growth driver is urbanization plus nuclear family. Even today, 65% population of India lives in rural area. But there's a clear trend of people migrating to metros as well as tier 2 and 3 cities for better job opportunities, better lifestyle, and it is expected that by 2036, over 40% of India would live in urban areas. So the demand for 10 to 15 lakh home loan is growing at a fast rate in these areas. And that's where these affordable housing finance companies operate. This was one of the biggest reasons why I also ended up investing in a couple of affordable housing finance companies in the long term. By the way, I share my portfolio details and investment thesis with the close community of investors via my weekly video series. The idea is to help you understand my thought process behind investment because many people do not have right knowledge or time for research. So that's where I try to add my thought process and share my investment strategy. Please note that this is not a buy or sell call, but the idea is to share my thought process. For more details, you can explore my website or join button of this YouTube channel. Then second growth driver for long term is huge underserved segment. Even today, India's mortgage to GDP ratio, that is home loan as percentage of total GDP, is just around 12%, which is much lower than countries like China, Brazil, US, UK. It shows how underpenetrated this segment is. If you deep dive, the biggest reason is even today around 80% of affordable borrowers, that is around 40 crore people earn in cash or salaried in informal sector. So they don't qualify for traditional home loans from PSUs and private banks due to lack of proper documentation like bank statement. And that's where affordable housing finance companies use alternate underwriting to assess the credit worthiness. Now this is very interesting. For example, they use banking surrogate, that is use of bank transactions as a proxy for income proof. It includes studying the monthly average balance, inflow pattern, expense pattern to estimate the income stability, average cash generation and seasonality in business. They also check bounce history and repayment behavior if they have taken any existing loan. Then housing finance companies use cash flow mapping, where they create a proxy income model based on nature of business or job. That is, whether it is could be a vegetable vendor, kirana store, Zomato delivery partner, then inventory turnover, then rental expense, footfall. So all these factors gives visibility into real earning and versus declared earning. Then home officers visit home and workplace to observe the standard of living, whether they have got fridge, AC, TV and so on, then type of construction of house, whether it is a pakka house versus kacha house, then size and location of shop or business. So these are the proxy indicators of income and repayment ability. And that's how affordable housing finance companies differentiate between good borrower versus someone who is likely to default. Then third factor is government support with schemes like PM Aavas Yojana, where target is to construct additional 2 crore rural houses between 2024 to 29. These schemes offer various subsidies. So all these factors would continue to drive the demand for affordable housing sector in India. Now let us quickly look at the key risk in the growth thesis. In the financial sector, one of the biggest risks is NPA risk. In case of affordable housing, the loan is given to mainly people from informal section of society that may not have steady income source. So there is always a risk of failure to pay the loan EMI due to health emergency, job loss, failed harvesting and so on. However, if you look at the flip side, there's an emotional connect with home. At the same time, there's a cultural mindset where losing a home is seen as shameful. People will cut expenses elsewhere before missing an EMI that could risk their home. On top of this, home loans are secured loan and are backed by collateral, which is the home itself. So even if the borrower default on payment, lender can take possession of property and can auction it to recover dues. So due to all these reasons, home loan segment usually has very low NPA. Then second risk is regulatory risk. Just like other NBFCs, affordable housing is also regulated by RBI that controls the lever of growth and stability by using various measures including repo rate changes, provisioning norms, then LTV, that is loan to value capping, capital adequacy ratio and so on. That way RBI avoid overlending and restrict aggressive growth. Actually, this regulation is good for sectors' growth and stability in the long run, but always a risk in case RBI tighten the norms due to negative events like increase in default. Then third risk is competitive risk. Let's be honest, housing finance is not an easy sector to crack. It's an extremely competitive space. You have PSU banks, top private banks, as well as specific housing finance companies that have very low cost of funds. So they can offer loan at lower interest rates, which may not be sustainable for small NBFCs that have much higher cost of funding. Having said this, as discussed earlier, the biggest differentiator between a large bank and affordable housing finance company is larger banks have much stricter loan approval process with proper documentation. And usually people from the informal sector don't have such documents and their application gets rejected. And that's where affordable housing finance companies use alternate underwriting model like banking surrogates. Second, the loan approval process is very long with larger bank, whereas affordable housing companies have much faster loan approval within few days. And third differentiation is in terms of technology. Affordable housing finance companies like Aavas, Home First, India Shelter, they use technology as a core, right from credit underwriting process to client onboarding to maintaining high collection efficiency to internal risk monitoring. And this is a very strong moat that has resulted in affordable housing finance companies creating their niche in this space. Having said this, competition risk can't be ruled out completely. I hope you got a fair idea of key risk that you need to track quarter on quarter while investing in this sector. By the way, in my weekly video series, I tracked the quarterly results of more than 200 companies. Since we are already in the Q4 result season, I am keeping a close eye to identify investment opportunities. Now let us look at the key players in this segment and do a quick comparative analysis on important KPIs. So first name in the list is Aavas Financiers. Founded in 2011 as a subsidiary of AU Small Finance Bank, Aavas Financiers has managed to grow its AUM at a very fast rate, and its PAT has also grown at a fast rate. Although its share price that jumped around 4 times between 2018 to 22 period has corrected significantly till March 24 due to multiple reasons including margin pressure due to rising cost of fund, slowdown in lending due to upgradation in technology, change in leadership and very expensive valuation during the last one. However, now there's a good recovery since March lows, and valuation wise also it has become very expensive during 2020 to 21 jump, but there's an excellent correction in valuation. This slide gives a good idea of its business breakup where if we look at AUM breakup by product, around 69% AUM is from housing loan, 13% from loan against property, and 18% is MSME lending. If you look at AUM by occupancy, 40% are salaried class and 60% is non-salaried class. In terms of AUM by state, Rajasthan leads with 33% exposure, followed with Maharashtra and Gujarat. And more than 85% loans are less than 15 lakh, where average loan for Aavas is around 9.5 lakh. Aavas started its journey with Rajasthan, Gujarat and Maharashtra and now expanding to various states. Company has a strong leadership team and even leading FIs and DIs are stakeholder in the company, and public holding is very low. Although its promoter holding is reducing, but that's because its promoter was a PE firm that was an early investor and then now they are booking profit. But it is absorbed by DIs which are strong hand and they are consistently increasing stake in the company. Then second stock is Home First Finance. It's a technology driven housing finance company where it facilitates quick loan approval often within 48 hours. Its credit underwriting process is also automated. Company has managed to grow its AUM at more than 30% CAGR in last 5 years and its net profits have grown at exponential rate. If you look at AUM breakup by product, 84% are housing loan. Interestingly, 68% of its loan book is with salaried class, where 85% have credit history. Its average ticket size is 11.7 lakh. It has strong presence in Gujarat, Maharashtra and Tamil Nadu and slowly expanding in other states. Home First also has a solid leadership team with extensive experience. If you look at the shareholding, FIs and DIs have good allocation. Here also promoter holding is reducing, but again because PE firm that were early investor are reducing stake and booking profit. But it's been absorbed by both FIs and DIs that include prominent institution, and public holding has consistently reduced in the company. Company had its IPO in February 21 at around 550 levels. It has slowly moved to 1250 level but has corrected recently. However, there is a good recovery in share price. Valuation wise, it is hovering in the median range of price to book of 4. Then third stock is India Shelter. It's an affordable housing finance company where around 99% loan applicants are women and 74% are self-employed. Company has grown its AUM at 40% CAGR rate in last 4 years and its PAT has compounded at 52% CAGR rate. Company has a strong board team with Sudhin Choksey as chairman. He is an ex-MD of Group Finance. In 2015, company has its presence in Rajasthan, Gujarat, MP and Maharashtra and now it has expanded its footprint to other states. It recently got listed last year at around 550 and currently showing a lot of strength in this weak market. Since it's a recently listed company, we don't have historical valuation benchmark. In terms of shareholding, its promoters hold around 48% stake that are again PE firm. Then FIs and DIs together have around 26% stake and DIs have consistently increased stake in the company. Remaining 25% is showing under public where 3 entities together hold nearly 18% stake. Then fourth stock is Aadhar Housing. It is one of India's largest affordable housing finance company with a network of 557 branches as of December 24 that are nicely distributed across country with presence in UP, Gujarat, Maharashtra, Tamil Nadu, Rajasthan, MP and so on. Company's AUM and disbursement have been growing at a consistently good pace with latest AUM growth of 21% in 9 months of FY25 and disbursement growth of 20% versus last year on year. It also has an experienced set of board of directors as well as leadership team. Now that we've got a fair idea about these 4 affordable housing finance companies, let's have a quick comparative analysis to identify the leading company. Alright, so this is the comparative analysis of all 4 companies: Aavas, Aadhar, Home First, India Shelter across important KPIs. First, if you look at the market cap, Aadhar has got the largest market cap 20,000 crore, followed with Aavas with 16,000 crore and Home First India Shelter in the range of 9,000 to 10,000 crore market cap. Branch network wise, again Aadhar is highest at 557, followed with Aavas and then India Shelter and then Home First. Now customer profile is important, that shows where the focus is. And if you look at Aavas and India Shelter, they have got focused on self-employed, right? India Shelter 74, Aavas 60%, whereas Aadhar and Home First are focused on salaried class. Then if you look at average loan ticket size, it's more or less same for all 4 in the range of 10 to 11 lakh. Next is your AUM, that is asset under management. Again, that is highest for Aadhar, followed with your Aavas and then Home First and then India Shelter. Next is AUM growth. Again, your absolute size is okay, but then what is the growth in AUM? And this is for 9 months of FY25 versus your March 24. So not the entire year, but then just the 9 months because Q4 results are still pending. So in 9 months, Home First has grown at 23% AUM and India Shelter at 36%. So India Shelter highest growth, followed with Home First, and then Aadhar, and then Aavas. So I hope it makes sense. The growth in AUM is very high for Home First and India Shelter. India Shelter very high. Then next is disbursement. That basically suggests what is the money they have disbursed for that particular period. Again, highest is your Aadhar and then Aavas. But then the important data point is the growth rate. And if you look at it, your India Shelter has got the highest disbursement rate at 28%, and then Aadhar is 14.6%. Next is net interest margin, right? So if you look at it, Aadhar has got the highest NIM, followed with Aavas, right? So that's about NIM. Yield wise, all four of them are at more or less same level. Next is your cost of fund, right? What rate they are borrowing money. And here again your Aadhar has got the best cost of fund at 8.1%, followed with Aavas, and then your Home First, and then India Shelter. Next is the spread, right? Spread is nothing but your yield minus cost of fund, and this is again highest for India Shelter. Okay, and then next important KPIs are ROA and ROE, basically your profitability metric. So ROA wise, your India Shelter is highest, followed with Aadhar Housing. And ROE wise, your Aadhar and Home First have got the maximum ROE. Then important KPI is the NPA, gross and net. And here your Aavas has got the best asset quality, although all four of them have got very good asset quality. Next is your final KPI on profitability, which is your net profit. Again, in absolute terms, Aadhar is highest, followed with Aavas, and then Home First, India Shelter are at par. But then if you look at the growth in profit, India Shelter has grown at 59%, so growing at a very fast rate. Home First is at second number at 24.7% rate. But then again, all four of them have grown at a good rate in your 9 months of FY25. Then if you look at the PE and PB, that is the valuation metric, all four of them are at par, right? So not much difference in terms of valuation. PE wise hovering in the range of 25 to 26, 28, and price to book wise they are hovering in the range of 3.6 to 3.4 nearly. So lowest is your Aadhar at 3.4 and Home First is at 4.15, right? But then more or less there is not much difference in terms of valuation of all these four companies. Having said this, Aadhar has got a slightly better valuation among four. Then I have also identified the promoter plus FIs plus DIS holding, excluded the public holding, and all four of them have got very good promoter plus FI plus DI holding. And finally the credit rating, where Aadhar and Aavas have got AA rating, and Home First and India Shelter also AA, but then minus. So one notch below them. But net if you look at it, overall all four companies are great. In few parameters, Home First and India Shelter are good in terms of AUM growth. Then in few parameters like NIM, cost of fund, your Aavas and Aadhar is good. Then ROA wise, your Aadhar is much better. ROE is also very good for Aadhar. And then if you look at net profit growth, it is better for Home First and India Shelter. NPA wise, Aavas is much better than others, but then all four of them have got good asset quality. And valuation wise, again all four of them are at par, but relatively Aadhar has got better valuation metric as compared to other four. So in this video, we discussed the latest update on affordable housing finance sector of India, including short-term versus long-term growth driver, key risk and top players in the space that include Aavas, Home First, Aadhar and India Shelter. And then we did a comparative analysis to identify the leading player. Overall, I am optimistic on this entire space and all four companies are looking good. Now you tell me which is your preferred pick among these four companies. And if you have any doubt, let me know in the comments. Also, if you are looking for guidance on investment strategy, you can explore my weekly video series. I'll see you next video. Till then, take care.